DaVita. The dialysis care company, serving approximately 220,000 kidney disease patients across over 3,000 U.S. clinics with in-center dialysis, home dialysis, and integrated kidney care.
FY 2025 revenue $13.6 billion. Q1 2026 adjusted EPS $2.87 beat the $2.32 estimate by 24%. Revenue per treatment $417.59, up year-over-year.
DaVita was founded in 1994 as Total Renal Care, building outpatient dialysis clinics for the growing end-stage renal disease population, requiring 3 times weekly life-sustaining treatment.
The company rebranded as DaVita in 2000, meaning giving life in Italian. Berkshire Hathaway became a major shareholder in 2011.
DaVita divested its physician group DMG in 2019 to refocus on dialysis and kidney care. The integrated kidney care value-based program now manages over 60,000 at-risk patients.
U.S. dialysis services generate approximately 85% of revenue. Medicare and Medicaid pay the majority, with commercial insurance rates driving margin variability across the patient mix.
International dialysis contributes approximately 15%, operating clinics across 30-plus countries with partnership structures. Integrated kidney care is a growing value-based care segment within the U.S. book.
FY 2025 revenue $13.6 billion. Revenue per treatment of $417 reflects continued reimbursement rate growth.
Q1 2026 adjusted EPS $2.87 beat the $2.32 estimate. FY 2026 adjusted EPS guided $14.10 to $15.20.
Fresenius Medical Care is the only global pure-play dialysis competitor. Comparable clinic density, larger international footprint. DaVita competes on labor efficiency and integrated care coordination, reducing hospitalizations.
Independent nephrologists operate smaller dialysis centers, often partnering with or being acquired by DaVita. Hospital-based dialysis competes for acute patients, but lacks DaVita's outpatient scale economics.
DaVita's moat is clinic density and patient retention. Dialysis patients require 3 weekly treatments within a reasonable commute, making the neighborhood clinic location a near-permanent relationship once established.
DaVita operates over 3,000 dialysis centers across the United States, concentrated in suburban markets with high Medicare and commercial insurance penetration that optimize revenue per treatment.
International operations span over 30 countries, Latin America, Europe, and Asia-Pacific, with DaVita holding minority and majority stakes in partnership structures tailored to local regulatory environments.
Javier Rodriguez has served as CEO of DaVita since June 2019, a 20-year DaVita veteran who built the company's operational and technology infrastructure before assuming the top role.
Rodriguez holds degrees from Cornell and Harvard Business School. Under his leadership, DaVita's integrated kidney care program has grown to over 60,000 at-risk patients. DaVita's bet on value-based nephrology.
DaVita, the dialysis care company, $13.6 billion in FY 2025 revenue, serving 220,000 kidney disease patients across 3,000-plus clinics with life-sustaining treatment 3 times per week.
Q1 2026 adjusted EPS $2.87 beat the $2.32 estimate by 24%. Revenue per treatment $417.59. FY 2026 adjusted EPS guided $14.10 to $15.20. DaVita's kidney care platform delivering.
Kidney disease is the silent epidemic of American healthcare. Approximately 37 million Americans have chronic kidney disease, and roughly 800,000 of those have progressed to end-stage renal disease requiring dialysis. DaVita runs over 2,700 dialysis centers in the United States and treats approximately 200,000 patients, making it one of the 2 dominant operators in a market where scale and operational efficiency matter enormously. The company's Q1 2026 results demonstrated that the efficiency investments of the past 2 years are translating into margin expansion.
Revenue for Q1 2026 came in at $3.416 billion, above the $3.356 billion estimate. Year-over-year growth of 6.5% reflects patient volume growth, modest per-treatment revenue increases, and the expanding contribution from integrated kidney care, DaVita's capitated care model for Medicare Advantage patients. Earnings per share of $2.87 beat the $2.33 consensus by 23%, a beat driven by operating leverage rather than any unusual items.
Integrated kidney care is the strategic evolution that separates DaVita's long-term investment thesis from the traditional fee-for-service dialysis story. In the IKC model, DaVita takes on a capitated payment for managing the full care of a kidney patient, not just providing dialysis treatments, but coordinating all aspects of care, including medications, hospitalizations, and transitions to transplant. If DaVita can keep IKC patients out of the hospital and better manage their comorbidities, the company keeps the savings. The IKC enrolled patient base grew 40% year over year in Q1, and the care model is generating positive margin in its most mature cohorts.
CEO Javier Rodriguez has led DaVita since 2018 and has been the architect of the IKC strategy. His central argument is that DaVita's relationship with dialysis patients, who visit a DaVita center 3 times per week, gives the company unparalleled touchpoints to identify deteriorating patient health before it becomes a hospitalization. That clinical intelligence, combined with DaVita's data infrastructure, is the foundation of the IKC value proposition. Rodriguez has been patient in building the model, resisting the temptation to grow IKC enrollment faster than the care management infrastructure could support.
The Medicare Advantage relationship is critical to DaVita's financial model and a source of ongoing tension. MA plans have been pressuring dialysis reimbursement rates as they absorb higher than expected costs from their enrolled populations. DaVita has navigated this by demonstrating that IKC patients generate lower total cost of care for MA plans than fee-for-service patients, an argument that is increasingly supported by multi-year actuarial data. The negotiation dynamic with MA plans will be one of the most important variables in DaVita's earnings trajectory through 2027.
Labor is the most significant operating cost challenge that DaVita has faced over the past 3 years. Dialysis technicians and nurses are specialized healthcare workers, and the post-COVID labor market drove DaVita's agency nursing costs to historically elevated levels in 2022 and 2023. The company has systematically reduced agency labor dependency from approximately 14% of total labor hours in Q1 2023 to approximately 7% in Q1 2026. Through improved retention programs, sign-on bonuses structured with multi-year vesting, and improved scheduling efficiency using machine learning tools. The normalization of labor cost is a primary driver of the Q1 margin beat.
Warren Buffett's Berkshire Hathaway is DaVita's largest shareholder with approximately 40% of outstanding shares. Berkshire has held DaVita for over a decade and has been a patient, passive shareholder. The Berkshire ownership position creates an unusual dynamic for other institutional investors. The float is effectively limited by Berkshire's block, which can create both upward pressure on the stock when institutional demand increases and potential downward pressure if Berkshire ever decides to reduce its position. There has been no public indication of Berkshire reducing its stake, and DaVita's CEO has characterized the relationship as stable.
International dialysis represents a meaningful long-term growth opportunity for DaVita that is still in early development. The company operates dialysis centers in 11 countries outside the United States, with the most significant international presence in Asia-Pacific and Latin America. International revenue represents approximately 12% of total revenue and is growing at approximately 10% annually. The strategic logic is that kidney disease prevalence is rising globally as diabetes and hypertension rates increase in developing markets, and the infrastructure required to treat dialysis patients efficiently is something DaVita has refined over decades in the U.S. market.
Valuation at DaVita is moderately compelling for a healthcare infrastructure business with this level of earnings visibility. The company trades at approximately 12 times forward earnings, which is a discount to most managed care and healthcare services companies. The free cash flow generation is substantial. DaVita typically converts over 90% of net income to free cash flow, and the company has been actively buying back shares over the past 3 years, reducing its diluted share count by approximately 8%. The Berkshire ownership does create a ceiling on buyback optionality, since DaVita cannot buy shares from Berkshire without complex regulatory considerations.
The key metrics to watch at DaVita over the next 2 quarters are IKC enrollment growth, per treatment revenue versus CMS rate updates, agency labor as a percentage of total labor hours, and international operating margin progress. If IKC enrollment continues to grow above 40% annually and the care model demonstrates additional mature cohort margin improvement, the IKC thesis will have cleared its most important validation hurdle.
The bottom line on DaVita. The Q1 2026 results confirm that the operational efficiency program is working, IKC is scaling, and the margin recovery story has legs through at least 2027. The business model is essential. Dialysis is not elective, and the competitive moat from network density and clinical experience is durable. For healthcare-focused investors, DaVita offers a combination of defensive characteristics and a genuine growth catalyst in IKC that is not fully reflected in the current multiple.
Let's talk about DaVita's integrated care strategy because it's the long game that management is betting the company on. The integrated kidney care platform now covers over 80,000 patients across value-based care arrangements, and that number has been growing at a double-digit pace. Under value-based models, DaVita takes on cost risk for the full care episode, not just the dialysis treatment itself. That alignment of incentives has driven meaningful reductions in hospitalizations and emergency room visits among enrolled patients, which both improves outcomes and reduces total cost of care for payers.
Berkshire Hathaway's position in DaVita is worth discussing because it has been a persistent strategic anchor. Warren Buffett's firm owns roughly 38% of the company's outstanding shares, giving DaVita a long-term patient shareholder base that limits activist pressure and supports management's multi-year investment horizon. Berkshire has been a shareholder since 2011 and has added to the position over multiple windows. That institutional backing also provides implicit confidence in the durability of the dialysis business model, even as home dialysis alternatives gain traction.
On the labor front, DaVita has made real progress normalizing its cost structure after the post-COVID staffing crisis drove wages and agency utilization sharply higher. Nurse and technician turnover rates have declined materially over the past 6 quarters, and agency labor as a percentage of total hours has fallen back toward pre-pandemic levels. The improvement in labor efficiency has been the single biggest driver of margin recovery, and there's still room to run. Management has guided for continued improvement in treatment cost per session as the labor normalization fully flows through the income statement over the next 4 to 6 quarters.
Looking at the pipeline for DaVita's international expansion, the company operates kidney care centers in 10 countries outside the United States, serving approximately 29,000 patients internationally. The international segment is growing faster than the domestic business on a percentage basis, driven by rising ESRD prevalence in developing markets and increasing public and private reimbursement for dialysis services. Management views international as a long-term optionality layer on the core thesis rather than a near-term earnings driver, but the portfolio of geographies diversifies the company's exposure to U.S. policy risk around Medicare rates, which remain the single biggest regulatory variable for the domestic business.
Everything on Charged Alpha is financial education and analysis, not personalized investment advice. Past performance does not predict future results. Always do your own research, understand your risk tolerance, and speak with a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.